Hi there, Adam Gower here, and welcome to the Gower Crowd podcast syndication in the digital age at gowercrowd.com. Now, today's episode is not about digital marketing. It is a focus on the state of commercial real estate as it stands today as we head towards the end of the year 2020. And my guest is Lisa Pendergast, who is Executive Director of the Commercial Real Estate Finance Council, CREFC. Now, I don't often do this, but I'm going to read some of Lisa's bio here from the crefc.org website because it contextualizes what you're going to be hearing today. First of all, Lisa was the president and former member of CREFC's Board of Governors for over 9 years. She previously served on the editorial board of the CRE finance world at CREFC. She's been a top-ranked research analyst in the highly competitive Institutional Investor All-American Fixed Income Research Team survey in the CMBS category. She is a multiple published author of articles and reports on various aspects of CMBS. She was managing director and head of CMBS strategy at Jefferies, and prior to that was managing director in the fixed income strategies group at the Royal Bank of Scotland. Put it mildly, Lisa knows her stuff. Now, what you're going to be hearing about from Lisa today is what to watch for in the winners and losers in commercial real estate during this pandemic, and who is likely to emerge stronger and who's likely to emerge weaker. How Lisa works with legislators to advocate for the commercial real estate industry and what that means to you. What macroeconomic trends to watch for as you look for investment opportunities and a whole lot more. Now, if you're a regular listener to the podcast, I'm going to be offering you some enormous relief from my usual whiteboard workshop recommendation and instead suggest that you go to the gowercrowd.com website and look for my new book, Syndicate. In fact, this week I've actually managed to publish 2 books, so you can tell what a great marketing planner I am. The first is for investors, and that was published by Routledge, one of the top 5 publishers in the world. That's called Real Estate Crowdfunding: An Insider's Guide to Investing Online. And the second book is called Syndicate. It is for developers who want to raise money online, and both of those books are accessible on the homepage of gowercrowd.com. So here she is. Without further ado, my guest today, world expert in CMBS, amongst other things, Lisa Pendergast, Executive Director of CREFC. Lisa, what a pleasure. Thank you so very much for joining me on my podcast.
Thank you for the invitation.
It's my
Appreciate
great
it.
pleasure.
Looking forward to the conversation.
All right. Well, so in our pre-start chat, you mentioned a few things, and I just have to go for the big highlight to start with. I'm dying to know. You talked about the world being a world of have and have-nots. Why don't we just start right there? Who are the haves and who are the have-nots? What's going on in the world?
Sure. No, thanks for asking that question because it sets the table for the rest of our discussion, I think. When I say haves, have-nots, I really mean who's involved in terms of asset classes where you can sort of see the daylight, and in some cases, maybe even benefiting from an environment in which we've all learned to live, which is amidst COVID. And then there are those that are being completely devastated as a result of COVID. So the folks, the so-called haves, are those such as industrial, where the e-commerce and the like have certainly been driven to new heights amidst COVID, and the beneficiaries are the industrial properties out there that are benefiting. Same thing, I think, to some extent, offices, because of long-term leases, currently are performing, and I'm looking at this first and foremost from a loan performance perspective, which in my mind is very reflective of what's going on at the asset level, right? So to the extent that multifamily, industrial, office all have delinquency rates in the CMBS market. And I use the CMBS market because it is one of the most transparent commercial real estate lending markets. So you'll get monthly data. That's not to say that you cannot get some level of data on the banks and life companies, but that tends to be quarterly. And it is far less granular than what you'll get in the CMBS market. So we use CMBS as an example. But in that world, it's 3% or less. However, when you go to a more operating business like a hotel, many of which aren't operating, were closed for significant periods of time. If they're now open, they're still working with a delinquency rate in a single digit, generally, number. So you have delinquency rates in hotel right now of about 23%, and you have retail delinquency rates of about 15%. Those are the have-nots in terms of just their well-being amidst COVID. And while I do think that some of these things will grow to be better, what we know in retail is that the distress in the retail market has persisted for quite some time. So unfortunately, for some of those retail assets, COVID is the thing that's going to push them over the edge. It either means change in ownership at some point, or the complete demise of the asset itself, where an alternative use is now what you're looking for as opposed to a retail location.
Isn't that incredible? Like a complete, what's the term God, redundancy is the wrong word, but.
No, but it is, I mean, in the retail market, as we've known, and, you know, I've been a research analyst prior to being executive director of CREFC for decades. And I think as a very young analyst in this commercial real estate space, you know, I think I was writing about Kmart 25 years ago.
That's incredible.
And it's amazing to me that we still talk about it sort of, you know, today. But
well, hang on a minute. What were you talking about?
Retailers.
What were you talking about 25 years ago with regards to retail? Wasn't it? I mean, it's like
Sears, Kmart. We were talking about its ability to continue to carry on. And so, you know, what stores will close? Will the whole chain close? Who's going to buy whom? You know, the Sears saga also went on for forever. And so, you know, I think that was the early indication of how like a Kmart might be replaced by a Target, who was younger, fresher, smarter about, you know, how they delivered what goods they were providing, right?
But still retail, right? It was just a different kind of walk-in retail outlet.
It's about a fresher sort of platform and or just something that no longer works in a particular area, venue. I think, you know, clearly malls right now are being hit extremely hard. Some of those malls that were teetering with tenants that also were teetering or certainly not working, we're starting to see, you know, the sort of cracks in some of these entertainment areas as well. When you think about it, everybody's smart mall owners decided to move toward the experiential. And
right.
that worked. And
so
that was brilliant until it wasn't. Right. Until no one wants to experiment next to, unless you're 6 feet apart from somebody else.
Isn't that crazy?
So it's just not, it's not really that experience focused retail, while brilliant, just doesn't simply work in the current environment. It will, again, at some point, but in the interim, the concern is how do you get over that period of folks just not coming to a mall that might have a great, you know, sort of offerings of entertainment type things for shoppers. You know?
So this is, it's interesting you say this, because what you were describing was the evolution of Kmart into Target, which is really just a different kind of retail. What I actually remember, I hate to think of it, it was probably around 25 years ago. I was running a division of National Amusements, Sumner Redstone's company, actually in Asia Pacific. And one of their premium brands was Blockbuster Video. And we realized even then that that was going to become obsolete, that technology was going to make video rentals completely obsolete. There was no replacement. It wasn't Target for Kmart. It was empty space for something completely different. And that's really what we're seeing now, isn't it, Lisa? I mean, is this acceleration of trends, especially in retailing, that what are you seeing in terms of a complete change in use across the retail landscape, right? Like adaptive reuse from what was retail to not retail now.
You know, it's unfortunately when you ask that question, the one thing it comes to mind is you see these blighted areas. right? And certainly, certain malls, it depends. Your B, C class malls that are out there have become just wastelands. That there isn't a replacement in many cases, depending on the location, depending on what's sprung up around that particular location. And frankly, when we talk about to regulators and legislators today about why we think commercial real estate needs injections of capital and help for borrowers to kind of bridge that gap, bridge the COVID gap, if you will. The thing we talk about is, do you really want to see these blighted areas across the country because no one could afford to carry that property for any longer during COVID? And in many cases, what you find is there's no replacement, especially for these larger sort of either community shopping centers that are bigger than a community shopping center, that are a little bit bigger. Who do you put in there to replace those tenants? And can you replace those tenants sufficiently such that you can generate cash flow to pay your debt service on your loan?
Yeah, it's incredible, isn't it?
Yes.
Are you not seeing complete reuse, like tearing these things down? I mean, they're well located, right? Surrounded by
If they
housing,
are, right,
presumably.
well located, they may get torn down and start over, or they may just be rebuilt from some form of themselves, right? But it's those that are in the areas there that have, so if it's a community shopping center, but the newest, bestest community shopping center is around the corner. And what do you do with that space? It needs to be something else.
You mentioned talking to legislators. That's something that you do, isn't it? Tell me something
Quite a bit
about
of
that.
lately.
Yeah, all right.
Yeah,
So
yeah.
what's your role in that? It's very interesting. And
So
what's the
we
thinking?
run,
Yeah.
CREFC represents all of the lending and debt investing community. So we represent CMBS lenders, life company lenders, bank lenders, these new crops of debt funds that have come up since the great financial crisis, previous crisis, as well as all the debt investors. So the CMBS bond buyers, the loan buyers, the mezz buyers, those types of folks. So we have been advocating on a number of fronts. The first real advocacy effort on our part was to try to get the CMBS market and pricing sort of back in line. When COVID hit, everyone knew it was going to hit hard assets like commercial real estate, one of the most hardest hit, I would argue. And then that would affect the prices on the bonds. So we saw, for example, on our benchmark bond, which is a 10-year AAA bond that is got 30% credit enhancement, a very strong, safe AAA security. But spreads on that bond went from about 90 basis points over the 10-year swap rate to about 340, almost within a week or two. And that's important because that's a big component of the security. However, we saw down the capital stack, BBB minus bonds really get hit, such that you went from a $90, $100 price point to something in the 60s and 70s dollars now, not basis points. So you lost tens of points on these bonds. What we did was we worked with the Fed who reinstituted TEL, the Term Asset Backed Securities Loan Facility.
I remember. No, yes.
Troubled asset. But this is TEL. This is yes, this is different. This was for bonds. And basically what it does is provide investors with a bit of leverage so that you can buy these securities and you can almost assure yourself of having a reasonable return, assuming that you have faith that that 10-year AAA bond is going to survive. And all of them did in the last crisis. So to the extent that it was important to us to get that sort of sponsorship for the CMBS market. And to the good, on April 9th, we were able to get, working with the Fed, who once again took out TELF, which was a sort of part of their playbook from the previous crisis, and reapply it to the current crisis. CMBS was one of the last asset classes to actually become eligible for the TELF program. And to the extent that it really did cause our spreads to go somewhere around 350 basis points on 10-year AAAs to back toward today, where they were about 100 basis points off, which is kind of where they were prior to the crisis.
So how did the TELF work? I'm sorry, I really
It
don't.
is just a mechanism, and I don't want to get too deep into it because
But
it's
it was
just a
basically a
mechanism.
backstop.
It is a mechanism that
Yeah.
provides leverage to those investors who wish to buy the bonds, with the
Okay.
idea of enticing people to be more involved in the sector, to feel comfortable that they have some leverage in terms of their return, regardless if this were to go down further. Really, it's to stem losses on these bonds ultimately. And I don't mean realized losses, I mean mark-to-market losses, right?
Okay.
So
Right.
we're quite comfortable on a 10-year AAA super senior bond that has 30% credit enhancement. You are not going to take a credit loss on that bond. But if you bought the bond at par, 100 cents on a dollar, and all of a sudden it's trading 70 cents on the dollar, then you have a mark to market, you have a pricing loss. And so the whole idea is to get people back comfortable to buy these bonds, and it gives them a little bit of leverage such that your returns are leveraged, if you will. And so it brings people into the market, and it quickly corrected the AAAs to a point where they are quite, kind of back to where they were. What's not, as I said, is down the credit stack in the triple B minus bonds, where you may take a loss if losses continue to behave, or I shouldn't say losses, but actual loan performance continues to be as difficult as it is right now.
So it keeps liquidity in the market,
No
basically.
question.
Right.
You said it faster and better than I did.
That's only because I'm not as bright as you. I need to dumb it down. But what I have been hearing, though, is that it has still been difficult to get credit. So talk to me about that and why. What is going on that makes it so difficult to underwrite commercial real estate at the moment, particularly on the lending side?
Sure. I think the most significant thing is the uncertainty. I think we've gotten past the point very early on in the crisis where it was really difficult even to get to an asset, to an appraised, valuations on assets. I think that's getting better the more we open the country to commerce. And so to the extent that the uncertainty comes with, if you were 95% occupied as, say, a retail property prior to COVID, and you're currently 50% occupied, what's the likelihood of you returning back to that 95% at some point in the future, and hopefully the near future? Or is this something that somehow is going to impact? I think the concern always is, it's not just the real estate, it is what does the country look like from a growth perspective, and the economy look like from a growth perspective several quarters from now, 2 years from now, 3 years. Are we going to be in this sort of double dip where you have this immediate impact of COVID that causes stoppage and occupancy rates to plummet, to an environment where that might start to get better, and yet you're in an economic downturn and a recession that could last for several years? And so how do you underwrite to something like that? And it does suggest that you're going to stick to and gravitate toward the asset classes that are more sort of stable. So industrial, for example, I think there are a lot of folks who are looking for industrial properties. Their outlook is good regardless of the economy. You still need to buy things from Amazon, and Amazon needs to ship them from somewhere, right? And they need that industrial, just outside of a city kind of an asset. And so I think that there's going to be continued food fights for good industrial. Office is a very different thing, though, because that goes back to two things. One, do more people just continue to work from home and they decide they need less space? Or two, that they're just not comfortable coming into a city using public transportation to get there, New York City's subways. What's that going to look like? You're protected currently by long-term leases in place for the office market. But when those leases start to burn off, the real question is, do you go back? And if you do go back, do you want the same, square footage? Do you want to reduce your sort of, platform such that you can have half your workforce come in, half the week and the other? So to me, it's the uncertainty in underwriting right now in terms of where rents are going, what the occupancy level is going to look like, what's it going to cost to retrofit that space to be COVID friendly, and to be able to fight the virus and have your employees feel safe in that office space. It's almost, and I'm sure folks are doing it as an analyst. I think what you would always do is try to look at any given MSA. What's the square footage or the lease burn off look like in a lot of these office properties? Because when that happens, there is going to be a reset, and it's probably going to be a reset to lower rents. Depends where you are. If you're in an urban area, probably reset to lower. If you're in suburban area, it's probably going to be reset higher. There was a period coming off the great financial crisis where, suburban office was Death Valley. It was really difficult to figure out where you were going to go in terms of getting that occupancy rate up in those suburban markets. Now it's quite the opposite.
That's really
wait long enough, everything changes.
Well, that's right. If you wait long enough, that's kind of where I was headed, is that, when we get back to normality, will it look the same as it did before? And the way that lenders underwrite is by looking at past performance, right? You look at what happened. You try not to predict, but you base it on what happened before.
Right.
What's difficult now is that what happened before may not actually look the same going forwards. It's going to morph. It's going to change.
Correct. That's correct. I mean, the forward-looking, the smart underwriters out there are going to try to bake in as much exactness as they can into what rents and occupancies are going to look like and demand. And yet a lot of it's going to be guesswork. And then the other side of it is, at the end of the day, you are going to underwrite more conservatively on a go-forward basis, given my concerns also that you will be in a recession, right? That just an economic perspective, the medical, sort of emergency goes away, but an economic one is here to stay for 24 or 36 months. And then how do you underwrite that loan? And what it does suggest at the end of the day for property owners or wannabe property owners is that your leverage points are definitely going to be far more conservative than they ever have been from a credit perspective. And even in the CMBS market, I think our lenders will feel that way. They're going to want to be more conservative, more reserves. As a borrower, there's going to be more upfront money that you're going to have to put in because you just don't know what the world's going to look like. And it means you're going to get less proceeds on a loan, which ultimately means that asset valuations and where you bid on an asset, if you're looking to buy, is going to bake all of that in, which suggests lower property prices as we move forward.
Isn't that interesting? So but now you work at a very, very high level in the stratosphere of policy in this industry, right? So it's not something that most people are witness to. So tell me, what inputs do you use to establish the kind of policy recommendations that you do? I know that you mentioned some data that you have. So I'm interested in not only what the data is, but where it comes from and how you use it to formulate recommendations at the policy level.
Sure. One of the things is you need to set the table and explain how commercial real estate is important, not just to our world, but to the environment, to the US, to various cities. One of the things that doesn't always come up is that when you look at commercial real estate assets and the cash flow they throw off, that's about 18% of GDP. And it's not a number that people would equate commercial real estate with. In addition to that, if you think about where people work, where are the employees? They are in commercial real estate of all sorts. So we house a significant number of employees, and without those houses, and in good standing, it does suggest that your employment rate, is going to fall. So to the extent that right now you see all of these large malls closing, that's a lot of jobs. Same thing with hotels. And a lot of these folks, particularly in the hotel industry, it's a fairly low wage environment, and yet they count on those wages to survive, to feed their children, to house themselves. So to the extent that it's meaningful, and that's something we've tried to get across. And what we've found is that while well-intentioned, many of the programs that have been stood up by the government really do not include commercial real estate. And I've stopped asking myself to explain why, because I don't know why. Seems like there's a good reason that,
Is it because it's politically unsavory. I mean, there's this idea that real estate developers owners are the wealthy, and so why should we be, you know, padding their pockets and not putting it somewhere else? I mean, there's, right?
You didn't hear that from me, but I suspect that there's a little of that concern. And I don't necessarily blame them, right? I mean, you need to be careful to make sure that those who can do, right? And that you're helping those who can't. And yet, arguably, the ones we want to represent are those, we want to represent all of our borrowers for sure. And we've worked with all of borrower trade associations very closely to bring that message that this is a sector that seems to have been ignored by the federal government. And so we've not necessarily seen help from the CARES Act, the programs that have been stood up like PPP, the Paycheck Protection Program, Main Street Lending Program. Both of those programs do not allow for passive real estate to be involved. So we're excluded from those programs. We've tried to put forth, and have had some wonderful help from Congress, from the Senate, from the House, in terms of recognizing the need, recognizing that we're not necessarily standing up for the public companies out there, say the big public REITs that can go to the capital markets to raise funds, right? And we'd like to help them all, but one would argue that the guy who owns 3 Marriott courtyards somewhere in the Midwest, that's not a guy that can tap the capital markets to get assistance. And so we're really looking to try to help that particular borrower. And I'd say to the good, there's been a lot of talk about loan forbearance. And what we've learned is that the word forbearance means many things to many people. My view of forbearance is whatever I do as a lender to allow for some leniency in getting you through this period of COVID is a form of forbearance. So we either say, we're going to postpone you having to make your payments for the next 6 months, with the goal being when that happens, you start paying rent, and those 6 months that you didn't pay get tacked on to the back end of your mortgage.
Right, okay.
Or we've forced you to put aside a lot of reserves for, PIPs, for any kind of improvement plan that you have. Go forward that, maybe your the hotel requires that you put into your property, say. Let's repurpose those reserves, whatever they might be, to pay your mortgage. And then we'll worry about replenishing those reserves when everything's sort of semi back to normal. And so there are ways to forbear. And I think within both the CMBS market, with the banks and the life companies, and to the good, the banks and the life companies got some regulatory relief on this issue from troubled debt restructurings, which normally would have required that you hold a significant amount of capital against those. They've been kind of given some relief in that regard. So there has been some help. And as I said, TALF is important, not because of just what it does for the capital markets, but the way in which you quote a CMBS loan is significantly based on the pricing of those CMBS bonds. If those bonds price low, yields go up, means your mortgage rates go higher. So the ability to continue to lend at a rate that is palatable to our borrowers was really determined by TALF and its ability to tighten spreads, to increase CMBS bond prices to a level where mortgage rates could be quoted from the CMBS market that were palatable to our borrowers. And the fact that the Fed has done a great job lowering interest rates, and that certainly has helped mortgage rates across the country and across asset classes to fall.
Mortgage rates are insane.
We should buy everything. I don't know.
I just refinanced my house again. That's just weird. I look at the numbers like free money. When I first came to America, was in the early 1980s, and I know you won't remember that far back, but it was the 20% mortgages. 20%. Yeah. You got 12% deposits at the bank, just depositing money in the bank. Really, now you look at the rates and you just think this is just free money. It's really incredible.
It's interesting to watch what's going on in the single family market and just how it's smoking. It
is. That's right. Yeah, it's really interesting. Well, that's also a world of have and have nots, though. Actually, right? I mean, there are those who can't pay their mortgages, and then there are those out there buying second homes.
Right. But I mean, I think you have this whole migration out of the cities, out of the urban areas into the suburbs. And that's a migration that, again, if anyone asked me about that in, the 2000s, 2010, like I said, during the last crisis, a lot of our distressed office properties, sure, there were plenty that were in urban areas, but there were a heck of a lot more in suburban areas.
So it's interesting you say, do you look at residential real estate as an indicator of how commercial real estate will adapt? Like, is that something that you take into account?
From an asset class perspective, yes. So when we talk about how residential people who owned apartments in Manhattan moving out to all of the various suburbs of the city, clearly then you say a lot of those folks don't also want to commute into Manhattan. So that therefore the suburban office property that's 3.5 miles from your new home is a perfect place, right? And if you're are fortunate enough to be the owner of that business, then you're likely to say, I'm going to move 3.5 miles away from my home. I will save my employees from having to take public transportation at a time where, and that's the difficulty. Uncertainty goes back to COVID. Even if, for sure, the world will be gifted with a vaccine of some sort. But I suspect it's going to take some time for a comfort level, for a safety level, and for everyone to be immunized. So, it could be some time before anyone says, the property values in Manhattan look pretty attractive, or rents have fallen dramatically. I'm a young person or a young couple. Let's move back into Manhattan. But that's not going to happen overnight if you've just made the big move outside of the city, and you may never come back.
You know what, as well, we moved from a major city about 6 years ago, completely unrelated to anything other than whatever was going on at the time in my life. And first of all, I'm very happy that we did. We live in an agricultural location now, but here I am talking to, I don't even know where you are. It could be anywhere. I presume you're on the East Coast in New York somewhere, right? It doesn't really matter. But once people make that move, you would never think to do it. But once you do make that move and realize actually that life is better, right? It really makes it difficult to even imagine going back into the center of a massive conurbation. Like, why would you do that? It took me a long time, by that. I came kicking and screaming. I lived in big cities all my life, but my wife wanted to move. So we moved here, and now I cannot imagine living in a big city. And if this goes on long enough, and if people do actively migrate, right, and aren't just locked down, that movement back really could have a generational shift in commercial real estate use.
Right. And of course, the other issue is as properties and businesses do go under, the impact on tax bases across the country, across the world, are really going to suffer. And then it goes back into that underwriting a loan amidst an environment with such significant uncertainty, right? Can you afford to run that city, and what needs to change in services decline, and but that's true, across the globe, as I said, and it's TBD. I have a certain level of confidence that we'll figure it out, and that it will return to normal 24 months
eventually,
eventually, where it's starting to feel like it's going in the right direction. But I think the uncertainty stays with us for the next 24 months easy.
So I have to ask you a question. You prompted me to ask you a question. I know that we've limited on time, so I'm going to wrap up. I'm going to move into the wrap-up phase. So my question is, if you had $1 million, it's an unfair question a little bit, spare, hanging around somewhere, where would you invest it? With all this uncertainty, but with all the knowledge that you have, policy and what's going in the industry, what would you be investing your money in? And it better be CRE of some sort.
I was just going to say, if I want to keep my day job, it has to be in commercial real estate somewhere.
Exactly.
I think if I could find on the cheap an industrial property, I'd buy one, hands down, and or a suburban office, right? Which you can find probably at a much better entry point
Mm.
I might find that industrial property.
Very interesting. And you know something, I actually think that co-working is going to become significantly stronger. Because although WeWork has had its troubles and is the most visible, the fact is it's an incredibly comfortable way to work. To go into a space where you are surrounded by other workers, even if they're not your colleagues.
Right.
And so if you are somewhere remote, right, you're not in the middle of a city going to a head office, but if you're in a suburban area, you can still work. I could work for, now what do you call it? CREFC. What do you call it?
CREFC. Yeah.
So if I could work for CREFC from here, but I won't sit in my house all the time.
Right.
If I go to a local co-working spot, I can be there with all the benefits, in fact, even nicer than a normal office.
Right.
Right. And still be working anywhere.
Yeah, that's true. I mean, you'd have to question though, at what point do the remnants of COVID or any kind of pandemic sort of has it stifled the desire for co-working space? Do you want your own space that you keep clean, that, maybe the cleaning folks come in the evening and they clean your space? I'm kind of, of that ilk where I probably would come in with my own bottle of something.
Yeah, I can see it in mine. I can see the pad of white sitting on my desk.
Yeah. So I do think that there is that concern, and especially, come from more of a Wall Street background where you sit on trading desks. I would not want to be in a co-working area in a trading desk environment. I mean, it's bad enough, right? Because it's all kind of communal space to begin with. And yet I knew at least my space. Every night I would go home and I would
polish it up. Yeah, it's interesting you say that, because my experience of co-working where I am now is that I did have my own space.
See, that's different.
I had a desk, I paid extra. This was my space, all the stuff was laid out.
That's different. That's very
different. It wasn't a rotating desk. Yeah.
Okay, different, yes.
All right, so I'll tell you what, let's wrap up. I've got 3 sign-off questions. Just quick fire questions. Sure. But before I ask my 3 final questions, I do want to ask you one thing. On your website, all the things that CREFC does, one of the things it talks about is being a meeting place for industry professionals. Now, obviously, you mean that not literally.
Not today.
Right? Not today. Yeah. But so how are people, tell me, because, my business is all online, capital formation, online, all remote, everything's done digitally. How have industry professionals adapted their communications over the last 6 months since this all started? And how do you think that will look in 12 months' time?
I think one of the attractions, and I'll make it quick, to CREFC after being sort of in large banks and the like for most of my career was that I was actually not leaving the business and staying with all my buddies that I kind of grew up with over the 30 years in the business. The fact that, be it a Zoom or in person, I don't think it matters. We just recently had a virtual conference this week, which went extremely well, but I was touched by the number of people who called me and said, it was so fun to spend the whole day with my buddies again, with people I know, with hearing what they had to say, and listening to the Woman of the Year award, and we awarded the award to Kara McShane and from Wells Fargo, and people were pleased about that, and it kind of felt like old times for just a little bit. So it tells me that people can get used to many, many things. They miss seeing each other in person, but this kind of does okay to fill that gap. I think at the end of the day, commercial real estate is very much, this sounds trite, a people kind of business, but it really is. In our world, we have lenders, investors, servicers, loan servicers. All of those people have to work together. Otherwise, it really becomes difficult. So I'm not sure I answered your question, but I think I did.
Yeah, no, the world is going to look different. We should talk again in 12 months. Let's see what it looks like. Let me ask you 3 rapid fire sign-off questions. 1, what are your personal key daily habits that keep you successful?
I work hard every day. I care about details, and you learn how to to get along.
Hardest lesson in real estate?
Don't buy high.
Okay. Okay, I'll leave it at that. That's fine. It sounds like a Sam Zell response.
Yeah,
You've been
right,
sitting around him too much over the last few days. I know that.
All right.
And for somebody apart from Don't Buy High, who is in commercial real estate now, well, my usual question is, what advice would you give them for how to invest? But probably it should be something a little bit different because you're on the lender side. Yeah.
I think you still want to buy right. To me, it's about just know the product you're purchasing, know who you're purchasing it from. Either you trust the numbers that you're seeing, you don't trust the numbers, you trust but verify kind of thing. Especially now, and just in this business, details matter, and the more detail focused you can be, the smarter the investor you are, and the smarter choices you will make.
Lisa Pendergast, Executive Director, Commercial Real Estate Finance Council. Thank you so very much for being on my podcast today.
You're very welcome. This was fun. Thanks a lot.
That was Lisa Pendergast, Executive Director of the Commercial Real Estate Finance Council, CREFC. If you want to find out more about Lisa, go to the podcast page for today's episode, where I have included some links, and you'll find some short highlight videos as well as providing you with access to my new book, Syndicate, which is specifically written for developers who want to raise money online. That is peppering my website at the moment, so you could barely go on a single page without tripping over access to Syndicate. So do please go ahead and check that out. It is a turnkey book that covers all of my top secrets how to raise money online using state-of-the-art digital marketing techniques. All right, that's it. Thank you so very much for listening. And thank you, Lisa Pendergast at CREFC, for your time with me today. It was really nice of you to join me. I know you are extremely busy, and I enjoyed our conversation very much indeed. That's all for this episode. I'll see you next time, and in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.